To South Africa now. Public sector workers over there voicing a bit of optimism after reaching a bit of a pay deal with the government after it improved the offer on the table to an increment of 5% compared to 4.7%. Unions representing nearly 1.3 million workers, that includes teachers, nurses and police officers, have been seeking a 6% wage rise for the 2025-2026 fiscal year, down from a demand of 12% when talks started in September. The General Secretary of the Public Service Coordinating Bargaining Council says a deal may be struck, quote, in the next week. He added that to control its finances, the government wants to link public sector pay increases to the consumer price index for the 2 years after fiscal 25-26, and that was still a sticking point. The revised offer is significantly higher than South Africa's inflation rate, however, which is moderated to less than 3% in November, and it's above the central bank's target rate of 4.5% for anchoring price expectations. Let's bring in Sumitra Naidu. She's joining us now with an update and more data and context on this story. So, Sumitra, both parties seem to be closer, right, to a figure they can both live with at this point. There's a 100-odd basis point difference between the positions they're taking. But assuming that the union does agree to a 5 or 5.5% increase, what does that do to South Africa's deficit and the wage bill?
Well, Rama, both the deficit and the wage bill are already high and have been a financial strain on the budget for years. Now, in 2014, the wage bill hit a peak of 35.7%. It has reduced. Last year, the public sector wage bill accounted for 32.1% of government spending, which is still very high. It takes up a massive slice of the pie. Now, by the end of October last year, during the medium-term budget, that forecast came through. The overall deficit was expected to widen by 5% this year. That's up from 4.5% that was projected in February 2024. So for this fiscal year, the Treasury now sees a budget deficit of 4.3% of GDP, up from a previous forecast of 3.7%. So this trend is just increasing. This wage bill is already weighing very heavily on the country's fiscus. The biggest line items of the budget is servicing debt, social grants, and then the public service wage bill. And these wage negotiations are not over as yet, as you said. I mean, negotiations will start again now on Friday. But government agreed to raise this offer to 5%, and the unions have said now that this is better to further negotiate. So they're still expecting to push higher. They're still looking for an upward movement, anywhere up from about 5.5% to 6%, as you said. Rama?
Indeed, and that brings me to my next question, which you set up so lovely there, right? The finance minister is going to be delivering his next national budget, right, on the 19th of February. So he's got this interesting balancing act, right, because he's got to accommodate this wage hike. But at the same time, the market is going to be looking at that deficit number and saying, look, you either keep this flat or you have to reduce it. By implication, that suggests he's got to cut something else.
This is so difficult, and they have been trying for a long time. So last year, the Treasury put a plan in place to reduce the headcount of public servants over the next 2 years. So basically start moving people out. It set aside about 11 billion rand for early retirement packages to reduce that headcount. So the headcount has reduced, but still very high, accounting for that 32% of spend. It will, obviously, we've got another year to go. It will remain a strain on the public finances, considering that South Africa is still experiencing very weak growth and tax revenues are declining. So he's in a really, really tough position. You also can't have close to 500,000 public servants going on strike. I mean, they account for really important positions. A bulk of them are in police and in education. But the spend also becomes worrying when you look at the salary scales and you look at annual spend. South Africa's wage bill as a share of GDP is higher than a number of larger developed economies like the United States, the United Kingdom, Australia, Japan. There's no doubt that borrowing will continue, and of course at a higher cost. A higher wage bill is also likely to impact inflation. As you said, the Reserve Bank already warned of this last year. Governor Lesetja Kganyago said in his comments as well that this and electricity remain a concern for inflation going forward. Now, even though inflation is starting to ease, the central bank is remaining really cautious. They alluded to this last year. saying that they're really concerned there are a number of factors that could impact inflation going forward. This wage bill, very much a part of those factors. So this could translate now into fewer or even no rate cuts this year. It's just not ideal in this economy. Also, citizens are really taking strain. So they're really banking on more relief coming through from the Reserve Bank. So, it puts everyone in a tough position, and it will be interesting to see how the finance minister manages this when we go to the budget next month. Rama?
Indeed. And even just before that, at Davos next week, I'm sure he's going to be answering some relatively tough questions. We'll see what Enoch Godongwana has to say. CGTN Sumicha Naidu joining us there on the line from Johannesburg.